This is for all the people that are looking to get into the stock market and are unsure of where to start, and for people that are spending a lot of money and want to curb their spending habits. Welcome to episode 21 of the Learn podcast, where first you learn, then you drop the L, and then you earn. I'm your host, Dean the Wealth Coach. You ever hear that saying, if you want to purchase something, wait 5 days, or if you can't purchase it more than twice, then don't buy it? This is the type of method that we're going to adopt for the stock market. A lot of people have come to me saying, oh, I don't know where to invest. Where should I start? And I say, start with your home. You can go around your house seeing the items that you purchase, and you can start doing some research on those companies. Another thing that you can do is watch this video up above that literally helps you figure out what things are on your home to where you can start investing. People that are overspending and want to curb their spending habits, start looking into these companies that you purchase from on a regular basis. For example, if you're somebody that likes to use Uber Eats, why not look that up and see if that's a publicly traded company? If so, research to see if it's something that you would really want to invest in. So right now I'm challenging you guys to take an audit of your last 30 days of your bank statements and put one side for needs and one side for wants. The needs, that's your necessity, so that's non-negotiable. And then you have your wants. You want to do is you want to write down everything that you spend money on that you want to reduce. And take your needs and wants, separate them last 30 days. Take a total of your wants to see how much money you're spending. That's potentially how much money that you could be putting in the stock market. You want to know like an average, take the last 3 months. But for this exercise, we're just going to do 30 days. So with those 30 days, you're going to take those wants. You're going to write down everything that you spent on. And just look up those companies and see if any of those companies are publicly traded. That will, one, give you a starting place to find out what stocks to purchase, which ones you actually like. Then the next thing that we're going to do now is whatever you spend money on in the next 30 days, you're going to match that and purchase. If any of those companies are publicly traded, you're going to buy a fraction or the whole share of that company. If you can buy the whole share of the company, then do so. If you're unable to, see if you can buy the fraction of that company. So I left a link down below where you can sign up to Interactive Brokers and you can purchase fractional shares of a company, or you can sign up to Wealthsimple. I also left my code down below, and you can purchase fractional shares from there as well. So once you purchase something, you got to spend that same value or purchase the share within your portfolio. Now your portfolio might get kind of funny because there's going to probably be some companies you're going to be like, do I really want to have this company in my portfolio? Or when you look to see the company's performance, if it's something that you really want to be investing into. So this is kind of like the building blocks of getting into the stock market. Because now imagine if you're somebody that smokes weed and you bought let's say $20 worth, and now you're buying the company, or you're buying the shares in that company, and you've seen that their growth or they have no growth in the last 5 years. Do you really want to be owning that company? It's like I'm pouring into a company that makes no money. So why am I giving them my money and they're not making any money? So then that'll help with the mind shift. Like, hey, I probably shouldn't be buying, or one, I shouldn't be buying their product because it's not good for me. It's draining my pocket. And two, the company sucks. So why am I still investing in this? Now imagine, let's say you spent $10 on Apple Care, but you're pretty cautious with like your MacBook or your iPhone, and you don't really use the eye care, right? So now you purchase the eye care and you purchase a fractional ownership of Apple. Now you look at the financials at Apple and you're like, oh, they're doing pretty good. Oh, they're one of the top performing companies in the world. And now it sparked your interest. You start looking more into their details, like their financial statements, and you're like, yeah, I can see myself with buying this company. So now, because you are paying for Apple Care and now you bought a fractional ownership of Apple, now, and you did your research, you're like, yeah, this is probably a company I do want to own. Now you can dig more into it. You probably put more money into it. And it's like, all right, if I'm buying other things, or now I can start putting money into the Apple to purchase the Apple stocks, the fractional ownership. I love the fact that fractional ownership came out because now there's no excuse for anyone not to invest. Wealthsimple and Interactive Brokers makes it very easy for us to purchase these fractional shares. And here, I want to give you 5 reasons why you should invest in the stock market. You get potential high returns. So now imagine before you're spending money, and say you bought a good company and now you purchased their shares and their share price goes up. You spent $14 here, and let's say a year later your $14 turned into $16. That's pretty good. Whereas before you lost $14, but here you have $14 that made $2 on top of your money. Imagine you keep doing that for like say 5-10 years, where you went from having nothing to having like $100,000 in your account that could potentially grew over time. Stocks are good because it protects against inflation. So as the price or the cost of living goes up and the stock, depending which ones you have, stock price goes up, it pretty much protects how much your money is worth at the time. Like, whereas in the traditional banks, if inflation goes up and you have your money in the bank, I'm sorry to say, but your money is losing its value. $1 today will not be worth the same tomorrow. If you leave your money in the bank, if you bought a bag of chips today is $1 and you left your money in the bank and it's not doing anything, and now tomorrow it's $1.20, your dollar is still $1. So now it just lost value, where this is $1.20, but your money's still $1. Also, it helps with accessibility. It's one of the easiest assets that you can liquidate right away. Whereas if you put money into real estate, it will take some time to convert it. So that's why it's pretty good to have stocks in your portfolio. Plus, it's if you are trying to get a loan or someone asks what your net worth is, like if you're like going to the bank or whatever, you can put your stock portfolio on there for your net worth. Next thing is potential passive income. So if you purchase companies that actually pay quarterly or monthly dividends, you'll get a piece of that because you own those shares. So that's the next good thing about having stocks. Whereas you spent money before, you weren't making any money, it wasn't going up in price, you lost it. Here you have a stock. The longer you own it, the more valuable it can potentially become. And if it's a company that's paying dividends, now you're getting a return on your money. Imagine you used to buy from company A, you bought stocks in company A, and now company A pays dividends. Let's say in 3 years' time, it's hypothetically speaking, but 3 years' time, all the money that you spent before, you got that back, plus you still have the share. And if you just keep that effect going, where you just continuously pour into your stock portfolio, the amount of money you can make is ridiculous. For example, Warren Buffett, he makes about, don't quote me, but like 66 million or 600 million off of Coca-Cola on a quarterly basis. That's from him as a 13-year-old boy up to the age of 89, where he just continuously bought into Coca-Cola shares, where he's like, I can't remember exactly how much he owns, but 600 million or whatever that number is of how much money he makes on a quarterly basis. That's insane. Now imagine if you were to do something that compound for 10-20 years. The longer you compound, it just does like exponential growth for your money. Don't interrupt compounding if it's unnecessary. So a few things that you should do before investing in the stock market. You want to educate yourself. So learn the basics of investing. Then you want to set financial goals. Assess your risk tolerance. So you want to make sure you're not buying anything that's not going to make you sleep at night. Develop a diversified portfolio. So don't just, if with the wants that you have, Stick anywhere from 4, max 10, but 4 is a good place to go. If you want to add something to your portfolio and you're not a big risk taker, you can invest in ETF, or you can do mutual funds. Mutual funds is like one of the safest things that you could do. A mutual fund is just a basket of investors coming together, and you purchase through a bank. With the bank literally takes your money and just pulls it into one place, and then just buys stocks for that pool of investors. Choose a reputable brokerage. So in the States, there's TD Ameritrade, there's Robinhood. For Canadians, there's Interactive Brokers. You can buy from your bank, and also Wealthsimple. Start small. So that's why I'm challenging you to do this challenge for the next 30 days. Anything that you spend on wants, if you do see something on the needs list and you like it, do the research behind it. If it makes sense, then purchase that stock as well. But I want to show you how much money is just you're literally throwing away by putting that money from wants into the stock market. If you're really disciplined, before you purchase that item, say, you know what, instead of purchasing that item, I'm going to purchase that stock and put that money there. So that way you're not losing that money can start gaining for you. If you just keep this snowball effect up, over time, you're just going to have a bunch of money that's actually growing and making you money, pending that you picked a good company by doing your research behind it. Last thing that you want to do is monitor your investments. And when I say monitor your investments, maybe like once a quarter or semi-annually or annually, to see what your portfolio is doing. It's not something where you're just watching it day by day and be like, how's this doing? Oh, should I still hold it? No, we're not watching price. We're just seeing what companies are doing. So that's the first part of the stock market that we're going to be talking about during the Learn podcast for the next couple of episodes. So that wraps up another episode of the Learn podcast, where first you learn, then you drop the L, and then you earn. I'm your host, Dean the Wealth Coach, and make sure you subscribe to the channel to stay up to date when I drop an episode.